Opendoor Technologies closed the shortened Friday session at $7.70, finishing just slightly in the red after an early surge that pushed the stock above $8.20. On the surface, the day looked like ordinary low-volume holiday trading, a quick morning rally and some end-of-session profit-taking. But beneath the surface, something bigger is happening. This week saw a sharp pullback across the broader market, and according to Mike Alfred, that pullback wasn't a danger sign. Instead, he believes it has created the ideal setup for a strong rally that could last through the end of the year. If he is right, then high beta, high upside stocks like Opendoor may be sitting at a critical turning point. And when you combine that broader market perspective with Opendoor's own internal catalysts, particularly the warrant dividend, the leadership reset under Kaz Nejatian, and the long-term platform vision, you get a picture of a company that could be positioned to move aggressively if the macro winds shift from fear to momentum. Today's script is about that exact setup. The alignment between what's happening in the wider market and what's happening inside Opendoor is creating one of the most intriguing bullish configurations we've seen in months. Whether this becomes the beginning of a larger move or simply a momentary shift will depend on execution, sentiment, and macro conditions. But the pieces are coming together in a way that deserves close attention. Let's begin with the broader market. Over the past week, equities across the board pulled back. Tech dipped. Small caps dipped. Real estate dipped. Risk appetite dried up quickly as investors moved to take profits, reduce exposure, and prepare for reduced liquidity heading into Thanksgiving. But according to Mike Alfred, this period wasn't a sign of weakness, it was the opposite. He believes the sell-off created the conditions for a strong upside reversal. When markets pull back sharply without a major fundamental deterioration, it often sets the stage for powerful rallies built on positioning resets, short covering, and renewed appetite for risk. This idea, that a pullback is actually a setup, is deeply rooted in market psychology. When traders get shaken out, when the weak hands sell, when the emotional selling clears, the market often becomes more stable and more primed for a rebound. And when that rebound comes, high beta names tend to outperform dramatically. These are stocks that move faster, stronger, and more explosively when markets turn risk on. They get hit harder on the downside, but they also recover harder on the upside. Opendoor is one of those names. It's volatile, it's sentiment-driven, and it attracts short-term traders, long-term believers, and speculative players alike. In a risk-off environment, this type of stock dips quickly. But when conditions flip, these are the names that rocket. Mike Alfred's perspective implies that conditions may be flipping. If so, Opendoor may be set to benefit disproportionately. Now let's connect that macro perspective with what's going on at Opendoor itself. The company recently issued a special dividend in the form of tradable warrants to shareholders and to certain convertible note holders. The warrants have strike prices at $9, $13, and $17, with clear conditions and expiration timelines. In plain English, this is a mechanism that rewards shareholders if the stock appreciates meaningfully. But more importantly, the issuance of these warrants signals confidence from leadership that Opendoor can reach those price levels. Warrants are not issued lightly. They are issued when management believes the company's long-term trajectory justifies significant upside. Kaz Nejatian, the new CEO, has been clear that this warrant distribution is part of a broader alignment strategy. He wants shareholders to have leverage to the upside. He wants investors to feel connected to the company's long-term transformation. And the warrant dividend is a structural sign that Opendoor is moving away from its previous model of rapid expansion at all costs and toward a disciplined, data-driven, operationally streamlined approach. This is central to the reset story. Opendoor is no longer trying to be the hyper-aggressive iBuyer it once was. Instead, it's positioning itself as a real estate technology platform, where precise pricing models, efficient inventory management, and improved cycling times become the primary metrics of success. This transformation won't happen overnight. But every quarter under Nejatian has shown increased discipline. Leaner inventory. Better spread controls. Slower but more profitable acquisitions. A strategic approach to risk rather than a blind approach to scale. This matters. Because when a company that once suffered from overreach begins rebuilding itself from the inside out, the long-term potential begins to look dramatically different. And that's why long-range analysts like Eric Jackson have placed ambitious price targets on Opendoor, including the now well-known $82 long-term target. That target is based not on the Opendoor of the past, but on the Opendoor that is emerging, a platform that can capture a meaningful share of the multi-trillion-dollar real estate transaction market. To fully understand the significance of that opportunity, consider the current state of the housing market. For most of this year, the U.S. real estate market has been frozen. Homeowners locked into low mortgage rates have been unwilling to move. Inventory has been scarce. Transaction volume has dropped significantly. These are terrible conditions for Opendoor's old model, which depended heavily on rapid acquisitions and rapid resales. But the new Opendoor is structured to withstand even these conditions. If mortgage rates begin to fall next year as expected, and if homeowners regain their willingness to move, Opendoor stands to benefit not incrementally but exponentially. Because Opendoor's business is highly leveraged to transaction volume. When volume increases even modestly, revenue, margins, and cycling times improve much more dramatically. This is why the timing of the warrant issuance and the emphasis on the leadership reset matter so much. They align with a likely macro shift toward increased mobility. Now let's bring this back to the current moment. If Mike Alfred is right, and the recent dip in the broader market has created the setup for a rally, then Opendoor becomes one of the primary beneficiaries. Because Opendoor's volatility isn't simply a function of its business model, it's a function of how investors treat the stock. When markets turn bullish, investors seek out high-impact names. They want asymmetric opportunities. They want leverage. They want narrative. Opendoor has all of these. Imagine a scenario where the market begins drifting upward into December. Tech starts rising again. Risk appetite slowly returns. Funds begin repositioning. Retail traders return to aggressive names. Meanwhile, Opendoor is quietly executing its reset, improving its margins, and setting the stage for Q1 and Q2 to potentially deliver meaningful operational gains. If the market gives just a little push, Opendoor's setup becomes dramatically more attractive. This brings us back to Friday's price action. The early spike above $8.20 showed that buyers were ready to step in immediately. Even in thin liquidity, there was upward pressure. The late-day dip into the $7 range wasn't a sign of weakness, it was a sign of the environment. When traders are heading into a holiday weekend, reduced-hour sessions almost always end with profit-taking. The lack of news also means the move wasn't driven by fear or fundamental change. It was purely positioning. That's why the weekend setup is so interesting. All the underlying storylines remain bullish. The warrant dividend. The leadership reset. The macro runway. The long-term transformation. The platform vision. And now, the additional perspective from Mike Alfred that the broader market may be gearing up for a year-end rally that could lift high beta names like Opendoor. Let's talk briefly about the $82 long-term target, because it ties directly into this. The target isn't meant to predict short-term price movements. It's meant to anchor the long-term opportunity. If Opendoor becomes the default digital pathway for real estate transactions, replacing old systems with streamlined technology, the company's valuation grows significantly. And today's movements, whether it's a 1% dip or a 1% rise, do not change that long-term horizon. What they do is create moments of opportunity where short-term volatility can be leveraged into long-term positions. As we head into the weekend, the key question is simple. Does the broader market follow the script that Mike Alfred outlined? If it does, Opendoor could be one of the most explosive beneficiaries. Because Opendoor isn't just a speculative stock, it's a stock undergoing a disciplined transformation at a time when the macro environment may be shifting in its favor. It's rare that internal catalysts and external conditions align. But right now, they are moving in that direction. The warrant structure rewards appreciation. The leadership reset lays the foundation for consistent improvements. The macro backdrop could begin to thaw, and the long-term vision remains intact. It's not guaranteed. It's not risk-free. But it is a high-reward setup at a moment when the market may be turning. If the rally begins, Opendoor is well-positioned. And if that happens, the next few weeks could become one of the most interesting chapters in the Opendoor story. That's the opportunity heading into this weekend. A company transforming. A market potentially bottoming. A setup forming. And a stock that has the potential to move aggressively if momentum returns. Whether that leads Opendoor into its next leg higher will depend on how the broader market behaves in the coming days. But the pieces are lining up. And for investors who believe in the long-term vision, this is exactly the kind of moment they watch for.